Hello, everyone. Welcome to today's session. Let's get underway. We'll start out with market analysis currently of where things stand. We're still overall in a bullish trend in this overall bull market, continuing this overall rally that we started 8 weeks or so ago. It's continued just to be a really robust rally. And is not showing any signs so far of slowing down. So we've seen this long-term trend now starting to move back up a little bit here. We'll see if we get divergence on this, which means that the price activity makes a new high, but the oscillator doesn't. So we'll see if we can get back up to, actually, this is not the top, it's this top. This time frame is just right here, this last year right here. So this top and this top. So we've already passed that. And running into some resistance, although we have been taking out some overhead resistance on S&P 500, so we'll spend a couple minutes looking at that as well, and seeing some of our shorter term indicators here set up pretty nicely still right here, not overly concerning, but we are running up into the extremes on a couple of these indicators. Momentum has yet to do it. It was up there, started to pull back on this last smaller retracement right here, this little hiccup on that line. But now it's starting to move back up again. We are seeing breadth, which is in this upper range, and also seeing, you can see that's in that upper extended range, and then sentiment is starting to approach that upper extended range as well. Buy sell ratio is also extended right here, and we've seen it, we saw it cap out here at about 6 to 1, starting to retrace back down now. Let's take a look at where we're at now. We're at 3.2, and we've had enough time here now in terms of distance, the length of time that we've had this green line above the red line. Essentially, every time we get that, that means we have a buy sell ratio that is above 1. Those are favorable market conditions that we want to be able to participate in. And if you choose, the bearish trends right here are market conditions you want to not participate in. So you can very simply utilize that as a shorter term indicator to say, should I be in the market or should I be out of the market, depending on the time frame. Now, a couple of different strategies we utilize are in the market all of the time, and that's one of the portfolio strategies with the new buy daily strategy. But you could also just focus on bullish market conditions, muscle stocks during those market conditions. That's one of the ways to be able to kind of steer clear of downtrends and only focus on the uptrends. So that being said, as we extend that range, we start to curl back up to, together. That can, this can last, this downtrend actually lasted a lot longer than normal and had a lot of ups and downs along the way. So we could pull back and we could make another move higher before we end up coming down here. Historically, if we pull in this chart, historically, this has been the most consistent indicator to utilize. It's a fantastic indicator for several different reasons. Number one is it gives you kind of a ballpark length of time. Okay, when we're looking at this length of time of, let's just look at, bearish trends here. That's a long bearish trend. This is a long bearish trend. And then you can see they're all about the same amount of time. Some are a little bit longer, but not much. This turned out to be one of the longer ones. And then same with the bullish trends. Okay, if you have the green above red right here, green above red, green above red, green above red, green above red, green above red. So you can see on average, the length of time that those uptrends last are pretty consistent. If I were to draw that, there's a little sloppiness right here. And then looking at the length of time, number one, and then also at the distance when it starts to approach the length of time that is traditionally long for that. If you look at all of the lines on here, they're all about the same length. Well, look at the length of this line right now and look at the distance, the wideness of the distance in the buy sell ratio. Okay, every time these spike, they don't last. We have this rhythm, we have this motion, and we move from wide to narrow to bearish. Okay, and then we look for the wide on the bearish after a length of time. We're looking at the buy sell ratio right here, and that can give us some indication of extremes, bottom extremes and top extremes, and then the trend. So we're looking for the extremes, and then once we have green above red, that becomes our trend. So early on in those trends, we get a real big spike, and we can say that's probably the beginning of the trend. Let's continue to trade that direction, and that becomes our bias for overall trend direction. So as those start to get extreme and get wide, it just the sustainability of that trend doesn't last. So remember, when if you ever hear it's different this time, it never is. It's never different. It's just different. It's the same game, different players, different scenario, different market situation, but it's always the same. And that is, markets overshoot and markets undershoot. And that's just the nature of trends. It's the nature of the humans that are driving these trends, because that is what we do. Is we get greedy and then we get fearful, and then we get greedy and then we get fearful, and we run through that cycle over and over. Well, the market is in a greedy cycle right now that just is not. It's not sustainable. It may be sustainable longer term, but it's not sustainable in the short term. So we've got to be paying attention to those, and then ultimately having a strategy to be able to utilize what happens. What am I going to do when I have this extreme? Well, typically, if we're at a bullish extreme, you're going to have some gains. So when these conditions start to get into that scenario, you've got to start managing portfolio risk, and that is, what do I do with my losers? What do I do with my winners? If you've got multiple holdings, then you can. The ideal scenario, in my opinion, there's lots of strategies and tactics to be able to manage a portfolio, but for momentum trading, we want to let the winners continue to win. We don't want to cut a winner short just because we have a profit and say, oh, wow, we've got a profit, let's take it. For this strategy, we want to try and get the absolute most out of an uptrend that we possibly can. So we're going to cut the losers. We want to cut anything that is losing instead of cut what's winning. So as you start to get extreme and you have stocks that have not participated in this uptrend, and you're like, it's just taking up space now, let me just cut it and get rid of it. Or have a strategy to cut it. Maybe it's close, but I need to just adjust my stop loss a little bit, or maybe I sell half of it now, or whatever the case may be. Just make sure you have a strategy in place for the extremes, the bearish extremes and the bullish extremes. The bearish extremes being like this, where we're deeply oversold and the markets have moved lower. Now we're overbought. We've had a nice rally to the upside, and now it's a little bit extreme. Again, whether or not that creates a full market reversal, that's not what we're interested in, because that happens with 2020 hindsight. It happens in the moment right now, but I don't know if it reverses right now, if that's going to turn out to be a longer term downtrend or not. So we're just paying attention to some of these signals as they present themselves, and then we adjust portfolio risk accordingly. And again, portfolio risk typically means how much, what's your risk that's on the table? How many positions do you have open? If you were to be stopped out of every position, what does that look like? If you were to, have volatility in the market and it drops, what does that look like for the portfolio at risk? So those adjustments can be made by adjustments from cash to holdings, or from holdings to cash. Okay, and that you could use a different vehicle for cash, but I wouldn't suggest it. It's just easiest just to use cash, and cash is paying pretty decent right now too, 5%. Nothing wrong with that too. So let's continue on here, and let's look at some of sentiment. We're also starting to tick back up a little bit here on sentiment with this rally, but nothing super exciting. So we'll see if we get a massive rally here that actually pulls us back up to this area, or if the momentum is giving us a clue, in addition to the buy sell ratio, that it's getting tired, that this trend is getting tired and may need a little bit deeper retracement overall. Now, for a lot of traders, the hardest part of that adjustment is, do I just flat out sell everything, or do I move everything to cash, or do I go put options or inverse ETFs, or like that's a part of the trading plan and strategy as well, is decide in advance what you're going to do when you get there, so that when you get there, you can make a decision easily and it's not a big deal. It's like, oh, okay, we're extreme. We're at the upper end of this extreme. Now, that being said, one of the easiest ways to manage the portfolio is to do the new buy daily. So I'm gonna cover this Thursday again, but I also want to cover it just briefly here. I just have it listed as MBD. So this is a strategy where we buy the new buy every day. Whatever the new buy is on the muscle stocks list, we buy it, and we buy 2.5% of it. What's interesting is that, and this has been an interesting portfolio methodology, is, and the rationale behind this is that we always want to be in the market, because we never know exactly which stocks are going to work in a downtrend, which ones are going to work in an uptrend. So we trust the overall ranking system, we trust the overall signal system, but because there are so many stocks and there are so many that can do well, we don't necessarily want to stifle ourselves to just one pick and then try and guess and say, well, which one should I buy? So we've talked about this before as well, to say, I'm going to utilize a certain methodology within TradersPro that equals this. This is my buy process. And then you stick to it, because it could literally be, I'm going to buy one stock and I'm going to follow that stock. The lower number of stocks that you have, obviously the risk increases, because you're then just putting all the eggs into that one stock. So here's just an idea. So this account, this one I started on September 1st. So we haven't been tracking this one very long. So it's still got a little time, but I've used this methodology for years, and it works great, because I'm not a very good stock picker. I don't like to try and find what stocks to pick. I like automation. And so I like things that will deliver something for me based on a methodology, and then I don't have to make as many decisions on that process. And because I never know, like my rationale could be completely different to someone else's, and that's what makes a market, is everybody's trying to anticipate what stock is going to be the best one or move higher. Well, in the vast majority of cases, human beings are pretty bad at trying to forecast the future, right? So what we do is we have to diversify, and that lowers our risk, but it also lowers the potential returns, but not by a lot. Because what's our benchmark? What's our goal overall? The goal is, number one, not to lose money. Okay, that should be our goal. Our overall investment strategy, number one, do not lose money. Okay, and guess whose strategy that is? That's a Warren Buffett strategy. I didn't make that up. That's his. So rule number one is don't lose money. Rule number two is see rule number one. That's Buffett's strategy. Do not lose money. So the ways to be able to do that is, we can be stupid and we can be really aggressive, and we can buy one stock and we can hope that works out, because everybody on YouTube is making a gazillion dollars, right? Well, there's a ton of fine print when it comes to every one of that, any scenario, and that is risk and reward. You do not get both. You do not get low risk and high reward. You do not get high risk and low reward. Okay, you can, I suppose. Your reward can be wrong if your risk is high as well. But my point is that we want to be able to use a methodology that allows us to not have as many emotions in the game. So do this every week. You don't have to do it every day, but as long as it's a systematic process, because there's a certain amount of work, but if you're logging in and you're tracking and you're doing things like that anyway, then right, anything worth having is worth working for. And this is no different. You're going to have to do a little work, but not a whole lot. So in this case, we're up 11%. S&P in this time frame is up 2% over the same time frame. So we've done pretty well outperforming S&P. We started buying during the drawdown. We started buying during the S&P moving lower. In fact, let me go back to here, and here, S&P 500. Once I get, if I don't use it, then all my security stuff resets, and then we have to wait a second. So let's give that a minute. Hopefully it doesn't last too long. There. Oh, come on. There we go. This is my computer, by the way. It's not the network. I forgot what I was doing. Oh yes, index, market ETFs, S&P 500, September 1st. September 1st was right here. So from here, right here to right here, S&P 500 has gone down, it's gone up, and from here to here has increased about 2.5% or so, 2.5%. And we had, with this portfolio, up 11% over that time frame. Now, I'm going to break out all the stats here, but not today. But essentially, if we go through the history, you can see there's been quite a few losers in there, but look how small they are. The biggest one was 15, 18%. Then we get 8, 9% losers. Then we start to get some winners here, and then we have everything else that's open. So we have all of the current holdings that are open, and we have some winners and losers in here. So the point of this entire strategy is to capture some of these, to try and get 100, 200, 300%, 40, 50, 60, 70% on some of these kinds of stocks, and let them continue to work. Eventually, these are going to also retrace. But what are we doing in the meantime? We're buying new stocks like the new one today and the new one yesterday. Okay, so these are new in the trend, and they may turn into stocks like these, and some of these may turn into 300, 400, 500 percenters, and we're just going to let them go until they stop. Okay, when I look at a chart like this is a chart where I'm like, oh my gosh, there's no way it's going any higher. It's going to pull back, and it probably will. But when do I sell it? When do I get back into it? Why should I sell it right here if it's already working? I can ask myself a million questions, or I can trust the system. And sometimes there's going to be cases where it does retrace significantly, and it's like I at least want to have a stop loss in place. So you can tweak things slightly to say, all right, instead of waiting for a sell signal, because it might, we've seen it happen. It retraces from 18, it comes all the way back here. You get a sell signal. But what ends up happening sometimes is it's like these are the strongest stocks. It finds support, and then it marches higher again. And so for the most part, I'm just going to let it do its thing, because it doing its thing and the market doing its thing ends up being a smarter strategy than me trying to decide, well, should I sell it now? I know that it's extreme. So that's also one thing you can do. If you're a shorter term trader and you're like, I just want to get in and get out. Well, a good way to get in is waiting for that hold to buy. So a hold to buy signal here, and then watching for extreme. Once you get to extreme, you know that it's going to pull back to the buy zone. The only risk in that is you don't know that if it's going to pull back to the buy zone here and then continue to march higher. So in my opinion, it's worse to miss out on a big winner than it is to get stopped out of a winner. Okay, so I would much rather hold on to a stock and let it do its thing and not sell it than selling prematurely and then having it rocket to the moon. If any of you have been trading for any length of time, I guarantee that's happened to you. It's happened to me countless times, to where you start saying, well, I'm going to do this or that. The key is your trading plan. The absolute key is, why are you doing what you're doing? Inside of this mechanism and inside of this trading plan portfolio strategy, that is what I'm doing. I'm holding on to it and being able to continue to just let it do its thing. It's just easier Whether or not it's more and more profitable, that's that's always up for debate. The market ultimately is going to do what it does. But by using this many stocks, we're also diversifying out our number of trades. So if you're the kind of person that's like, you're in the market and you make a trade once a day or every other day, or and you're like buying and selling and you're getting in and then you're getting out, and if you're making those kind of trades anyway, why not do it something like this to where you're adding some consistency? It's a slower process. Okay, this is a portfolio management, stock management process. This is not trading one stock, letting it pop, sell it. This is not trading the options and seeing if I can make a ton of money. This is not everything that's sexy about what people want. This is not, this is a longer term strategy to not lose money. Okay, and that is ultimately, by not losing, then we are going to win. We are going to have winners by protecting our losses and protecting our overall our asset management strategy. Now, this pie doesn't have to be your entire account. It could be, but I wouldn't start out that way. If you've got 100 grand in all of your investable accounts, start out with less than that. Start out with 20,000 and do this with just a fraction of the overall account size, so that you can get comfortable with the process. Now, what you can do is you can increase your dollar amount and increase your portfolio size, and even increase it. I've got 2.5%. Every trade that goes in, it's 2.5%. A lot of times on your broker as well, you can set up a new buy market order, 2.5% of my capital, boom, done. Click a button and you're in. Okay, so it's very easy to manage the strategies as well within a brokerage account, because you can allocate a certain percentage on the purchase that you want. Then you don't have to figure out the number of shares to buy. Your brokerage account's like, okay, you want to buy 2.5% of capital. It ends up making this number, the total shares and so forth. So it's a strategy that allows you, like for me, what stocks of these would I have known about? Number one, okay, and things are going to happen here, like IREN. This is an oil stock. So we're getting oil now pulling back. It's had a pretty big retracement back, but the buy, and look at the volume on that. So it hasn't reached a sell signal yet. It's having a nice pullback. It actually looks really good, really constructive in this uptrend, counter trend, finding some support, a little bit of a hold right here. See if we can ultimately get that to move higher. Now the original purchase was the new buy. Let me get rid of volume so we can see that. Either down here or up here, I can't remember which. And it had a high rank because it had a big run up already. So it had a big run up, it had pulled all the way back, and then you get a new buy signal. Even though it's not in that upper trend, that's okay. It's like I just am rolling with what I'm given, and ultimately in this case, the market conditions are working. Remember what had happened here. Where was it? September 1st. Well, the market top ended up being right here. Our buy sell ratio, I think, started to turn about here as well. And so in a lot of cases where your buy sell ratio is less than 1, you're not even looking at any stocks to buy anyway, if that is a part of the strategy. In this strategy, I still am buying even in downturns, because some of those stocks end up moving. But a lot of the ones that ended up not working were ones that I probably wouldn't have traded. And so there is a potential to magnify the returns by staying out of the market in this strategy when buy sell ratio is less than 1. I got in a little bit deeper than I wanted to, but I hope there's some finding some value in that method, because it is by far, in a way, it's really what I built this entire system to do, is for this strategy. You can just do it with different stocks if you choose. If you want muscle minis, if I want to do $1 stocks, $3 or $4 or $5 stocks, same idea. It's still going to float the top stock to the top, 97 rank inside of this one. Or as we've mentioned before, you create your own screen. So this one here, 555, this has got all stocks that are between 3 and higher, 100 million market cap, 500K in volume, and then some fundamentals. And remember, the fundamentals that we're primarily focused on with momentum strategy are the fundamentals that create momentum, and that is cash, okay? That is earnings, annual EPS, last quarter EPS, and sales. This is cash coming in this quarter. This is sales increase coming in this quarter. These, I want to know if there's growth. The stock will tell us if there is, but that also allows us to screen for those kind of stocks so that we're able to find them already and try and find the path of least resistance on some of these stocks that are moving nicely. Annual EPS, ROE not as important, but remember what ROE does for us. ROE is what is management doing with this money? So you're generating cash, but are you efficient with that cash? So you really have the four things. Okay, really there's only two, and that is earnings and cash, and what is management doing with that cash. So these are the core metrics in terms of any fundamentals. There are a lot of other ones that are out there that are helpful, cash flow, different things like that, because it's kind of the same idea. If you have free cash flow and you have a company that's generating a ton of free cash flow, well, then they can take that cash flow, and then what are they going to do with that cash flow? Do they reinvest it? Are they growing like crazy and they're taking that cash and they're pumping it back into the company? Those are things that you can also you can overdo it, I suppose. So, and for the most part, if we have really good sales and we have EPS growing and we've got positive ROE, we know that management is doing something with it effectively, and the company is clicking. They're at least growing on with sales. We can add those into our fundamental side of things, because those are the things I want to know. Is a company growing? If it is management doing anything good with it? Yes, yes, yes. Okay, now let's look at timing. Now let's look at the pattern. Not even the pattern. Let's look at the signal. So these top two. So here's Intuit. Intuit, for example, you know them. They own QuickBooks, TurboTax, Rocket Mortgage. It's a great company. Had a decent retracement, and you can see the last EPS up 100%, last quarter EPS up 185%, and sales at 9%. When you have a $159 billion company increasing sales quarter over quarter at 10%, that gets harder and harder and harder to do. So sometimes the size of these companies affects their ability to grow. So it's actually very impressive that a company this size has been growing the way that it has, to be able to increase their stock price by 50% this year. Okay, so that shows up in the scan, and again, it would have been as of yesterday. So because it went from a hold to a buy, so there's a new entry in that overall scan. So I could say if I were following that method and that were my scan, I wouldn't have chose this one. Why? Because it's not my top rank. I would have chose this one because it is the top rank. Hasn't moved yet, but same story right here. Here's my method. Here is the screen that I'm focusing for. And if this is a daily process, sure enough, I'm going to go in. This happens to be, I think, the number one stock on new buys as well. It is. So this one I ended up adding in today. And there's times where it does this. There are times where it ends up going, here's your new buy. It's at the top of the range, and then turd, right? It just immediately retraces. You get stopped out. Well, we have another opportunity, potentially here or potentially here. It didn't show up in the scan, or maybe it did here, but there maybe was a stock that outranked it. So I would have chosen that stock instead. Okay, so in this case, that's the top of this list. So you don't necessarily have to use these predefined scans. They're there because they're predefined, but there's a lot of them. If I want something that is a little bit more custom to maybe my own risk tolerance or my own liking, maybe we've talked about this before, some dividend stocks or things like that, then I can approach this method. Or it's like I'm only going to focus on these stocks every Friday. Whatever stock is there every Friday is the one I'm going to utilize and manage my risk. And then it's a statistical game at that point moving forward. Some are going to win, some are going to lose. The ones that win, we keep holding on to those, and ultimately those become our biggest winners. We don't hold on to the losers and hope that they recover and hope that they turn into a winner. They're telling us by being a loser that it's a loser. and it's not worth our time to hold on to the losers. We're only going to keep what's working, and working means it's going in the right direction, and that means it's continuing to be profitable for us. So that's the overall methodology. You can tweak the methodology based on market conditions. I could say market conditions are extreme. Maybe I don't buy market is extreme. Those are things that we don't necessarily have an exact track record or anything to prove. These are just simply, we know that these momentum stocks, when they're high quality stocks and they're moving and market conditions are really, in any market condition, you're going to have some winners. Most of the time, these, and during a downtrend, it may be a different sector. Maybe it was oil, because remember, we had oil stocks really rocketing higher during this downturn. So if we really want to use it to its fullest, then we're going to look for something to focus on each day. You don't have to have a big account. If it's 10,000, something like that, you just buy less shares. Okay, don't get super hung up on the idea that I got to take that 10,000 and I got to double it in the next 30 days. In order to do that, it's just hard to do. You don't see hedge funds or any really big institutional money that is, it's a little bit more conservative, saying we turned our 100 million into 200 million in 30 days. Some do, and they take ridiculous risk, or they're very, very good at what they do. But point is, set the expectation to be, how much risk do I want to take? I can always tweak that. Okay, I can always tweak. In this case, I still have quite a bit of cash because the percentage of the allocation is 2.5%. If I were doing 5% per trade, I would probably be maxed out, and I'd probably have a lot higher return, because some of these stocks that have just really done well would have had a larger allocation towards them. Otherwise, I also could have lost a lot more because I had a higher allocation. So obviously, the larger your allocation to each trade, the more volatility you're creating. And by volatility, I just simply mean this number is going to jump up and down. You might be up and down 3% or 4% a day, something like that, instead of maybe 2 or 3% a day, similar to market conditions. But each of your stocks, you're going to have a stock that goes up or down by 10, 15% a day, but you're not as stressed out about it because your allocation to that volatility is lower in the grand scheme of things, in the grand portfolio allocation of things. Let's continue on with a couple other market conditions. So bonds, if we talk about bonds, we're looking at the 6-month time frame on TLT. Let's go out to the 1-year chart, because it's hitting that 50% retracement right here. You can see there's just nailed that really strong, finding some support today, that 92.78. If we retrace, find some support, that should be our floor on bonds. We come back here and then look for some more upside overall here also, and that's still looking positive for bonds, which is positive for lower interest rates, which is positive for equities. If we see bonds retrace, which they certainly could after this nice of a run up, pull back a little bit, equities will probably retrace with that as well. But both could have a retracement together, find some support, and then ultimately move back up, continue this overall uptrend from here. Just that overall uptrend moving higher. That's what we want to see. We want to see it stair step. Ideally, if it came back to that 92.78, find some support right here, move higher, retrace, break out, retrace, do the same dance here. That's what a trend does. That's what an uptrend looks like. Just like a downtrend, retraces, breaks down, retraces. Here's our level, breaks down. Okay, when we're in this uptrend, we can confidently go in a little bit more with some confidence, because it's in this uptrend and now it's pulling back, and now you can confidently go in and say, I'm pretty confident about buying TLT at 92. If it gets to 92 and finds some support right there, I think I'll take a stab at it, because it's a retracement zone. It's a solid demand support area, and I could get some more upside. So you can use this entire structure to be able to also help your timing, add positions, add something way after, add something in that's already in a trend versus newer in the trend. If you want, like, man, should I be buying bonds right now? No. Stocks are going to be better, but bonds are not bad. If I did want to have some of that, I would, I'd focus on a retracement back into this area, a way to be able to use that line. So we're seeing bonds, continue to have that overall uptrend. We also have been watching the sector ETFs. Everything's across the board is still bullish, minus energy, which is oil is continuing to pull back another 4% today. So it tried to rally right here. This is just the nature of a downtrend, is when it's in that downtrend, these moves back up again are counter to that trend. And it didn't even get back very far, but it got to this gap right here. Didn't even fill that gap, and this continued lower. So there's lots of selling pressure in oil. I love it. Keep it coming. I want to see oil. I want to see this at $10 and then 99 cents. I don't care if oil goes away or drops to zero. It's not going to, obviously, but as it's moving lower, I'm saving money in my gas tank, and probably heating bills and clothing costs and containers and food, and oil isn't everything. Okay, so that's kind of market conditions here currently. We talked a little bit about portfolio strategy and some of the new buys that are in there. CAMT, CLS, Shopify. There's a lot of them within this overall group. Don't forget about focusing on muscle stocks and stocks that are in those overall uptrends. And you can create a scan that is a muscle stock, not extreme. So in this case, these are stocks that are, that's not a good example because it's got a split that needs to be updated, although that's still not a bad price pattern. I'll come back to that one. But let's see if we've got a couple of those in the top of the list. Sometimes that'll happen on those. I've got to clean that up just a little bit, but let's say LMB. We know this one. This is a stock that it's a really fundamentally good stock. They do commercial HVAC, heating and air for big commercial buildings, and they've just been crushing it. And it's not extreme, even though it's at the top of the uptrend. It's not extreme. It's inside of that buy zone. So if you still want to be able to sort for high-ranking stocks, good fundamentals that is not extreme, you can create that scan as well, and then you're not having to sift through everything to look for that. And again, you can also look for screens that have, sorry, I just coughed into your ear, screens that, oh, I got to go back here. There we go. Lost my train of thought. That have fundamentals and that have new buys. So 20, hold to buy. Let's see if there's anything in there. There's none. 10, hold to buy. 1, ROAD. So let's look at this stock. That's a really nice looking pattern. Construction stock, fundamentals. Now what the scan is looking for is it's looking for the 10, at least annual EPS is greater than 10, last quarter EPS greater than 10, sales greater than 10. Those three things that we talked about are all greater than 10, and it has a new buy signal. So I'm combining the growth of the company with the momentum of the stock. Okay, and so we try to get the best of both worlds, because ultimately, as I've mentioned before, a stock price is nothing more than the present value of the future earnings of a company. The company has to be working for the stock to go higher. If it's not, and it doesn't have good earnings, it can still go higher, but ultimately the stock will reverse if the company doesn't perform. So that's why you see stocks that continually have good earnings and they're moving higher, their stock price continues to move higher. But in this case, you've now got a momentum zone stock. It's pulled back. It's got lots of support right here at that $40 range. Now it's really fundamentally sound. At least it's fundamentally growing. Okay. Again, those other factors, like maybe they have a ton of debt, or maybe there are other factors that come in, but I'm not interested in that right now. I want to know if they're generating cash and generating earnings. Okay. So sales coming in, EPS, earnings per share, is increasing quarter over quarter, year over year. And now I've got my signal, my entry signal. And I've got a management method to be able to say, okay, I'm going to set my initial capital. My stop loss always goes at, a certain level here. When I typically am adding a stock, it'll go something like this. I'll add it to the portfolio. I'll come into a portfolio, and I always do the calculations on this point area, this area first, so that I can kind of get a ballpark idea of where to place my stop, because I still want to have an initial stop loss in place. So I would go, again, my strategy is 2.5%. So down here, I'm looking at 2.5%. Well, I know that 100 shares is going to be too much. That's 4,300. So let's just ballpark it. Let's go 70 shares, 2.73. That's too many. 2.34. That's not enough. 65. That's close enough. 2.5. 2.5. If I have no stop loss at all, and this stock dropped to zero, I would lose 2.5% of my portfolio. Would I be able to feed my family still and pay my mortgage? Yes. If this stock completely got obliterated and it dropped to zero, I'm going to be okay. Okay. That is step number one of setting up a trade. What does this mean to you and your money? What does it mean to your livelihood? What does it mean? Because I don't want to lose. Okay. First and foremost, we do not want to lose, but we also realize that that can happen. So this is my max loss. I can't lose any more money than this. Why? Because I'm only investing $2,800 of my $111,000 into this one trade. But I want to add one more factor to that, and that is looking right here, this low point. I want to go below the 236, and I want to go reasonably low into that area. So let's just say that we're around, let's call it $39. So my stop loss at 39. What does this do? 2.5. I like to have this at 0.30 or less. So this would work for me at 39. It's well below that $40 support area. If it retraces and moves lower, fine. I need to protect my capital to begin with, and this is how I want to protect that capital at this level. So if I get stopped out, I lose 280 bucks of my 111, which is 2.25 of 1%. Boom, done. Buy it, we're in. Okay, now, and I could take that out. Now I know the number of shares. If I need to go into the brokerage account from there and say, now I know I need to buy 65 shares with a stop loss at 39. Okay, that took us 45 seconds. Then you go into your brokerage account, another 45 seconds to execute the trade and set up the stop, and you're good. Okay, that's the risk and money management portion of what I would do. Now from here, what do I have control over? I don't have control over diddly squat. I can't do anything. The stock's either going to go up or down. So I can say, oh, I got stopped out. Jesse, you're such an idiot. Well, that doesn't matter. That all of that's completely irrelevant, because I've set up a plan and a system and a mechanism, and I'm confident and trust in that mechanism enough to know that, so what, it gets stopped out. The next one may work out. The next one may work out, or the next, yes, we can have drawdown. Yes, we can deal with ups and downs, but the way the system is built is the winners will continue to work, and it takes a little time to start working. Now, if your portfolio gets so huge that you've got all winners in there, obviously this one's not to that point. We're getting pretty close, but if you're getting to the point to where everything, you're full, you're maxed out, you've got no more cash, and everything is winning, then we would drop off a loser. We would sell this loser no matter where it's at. Sell the bottom one and then add the new one, because I don't want to have any more than about 50 stocks overall. So you still get diversification, and you still get the ability to enter into that. But you don't end up with 500 stocks, because now you're just the S&P 500. You're over diversified. We want to still have a little bit of bang for our buck, but we want to have a little diversification as well. 50 stocks is probably over diversified, but for this strategy, I want it to be relatively conservative. I want it to be something that I'm going to outperform the market, but and try and get that 20 to 30% annualized type return without taking extreme amount of risk, and stock only. Just buying the stock, leaving it alone. I don't want to fiddle with anything else. Granted, you can add this. This is just a starting point. It's a starter portfolio, for example, of being able to manage that type of idea and manage that methodology. And then you branch out into other methods that may include different vehicles like options or ETFs or inverse or leverage or different things like that, like we've talked about before. So just to summarize, market conditions, we're enjoying a nice uptrend. We've got a retracement potentially here on the horizon. We've got buy-sell ratio that is wide. And so we may see just some consolidation right here. We may see a reversal or a retracement, which in my opinion should turn out to be an additional buying opportunity from there. So thanks everyone for your time and effort, and we will see you on Thursday. Thanks a lot. Bye now.